Hey gang, welcome to another episode of Value Added, the real estate podcast. On today's episode, we're chatting with Spencer Gray. Spencer is the founder of Indianapolis-based Gray Capital. Gray Capital focuses on the acquisition and management of multifamily apartment buildings, primarily in the Southeast and the Midwest. They are controlling right now approximately 9,000 units spread out around those markets. So without further ado, let's get on with the show.
Welcome to Value Added, the real estate podcast where we speak with the brightest minds in the world of real estate who provide, create, and realize value in an ever-changing market. And now your host, Nick Walters.
Let's talk about that. What I was listening to the Daily, the New York Times podcast, and they were talking about the freeze in Texas. This is some serious stuff. The guy that they were interviewing, it was 25 degrees, not outside. It was 25 degrees in his house. He's been without power and a lot, without heat for like a week. Pretty crazy.
And they're not used to it down there. I mean, I've got, family down in Texas, and I've been hearing those same stories of, whole areas just without power, no heat, and, record low temperatures. And it sounds like the Texas, the authority that manages the power grid kind of screwed things up. I don't know all the details, but natural gas shortages and crazy.
Yeah, that sounds more like stories in Indianapolis in the Northeast, where we're both are, not in Texas, right?
Yeah, I mean we're used to it, changing climates and with the seasons, but they're used to things getting a little cooler, but not exactly freezing by any means.
Yeah.
So,
well, out of college, I spent 3 years in Dallas, and I tell you what, the few storms that I did see down there, whether they were ice storms or snowstorms. It is true that people in the South and the Southwest that don't experience bad weather, they're not very good drivers in those conditions.
That's exactly what I was going to say. It's
no offense
amazing
to anybody down there.
But it's like the same. The first day that it snows, even here in the Midwest, everybody forgets to how to drive in the snow, but. A quarter inch of snow on the ground in like the South, all of a sudden cars are off the road. There's pileups, and all of a sudden your brakes don't exactly respond the same. So
exactly.
Adapt.
Well, listen, man, thanks for coming on. We're live, but I want to ask you, before we get into Gray Capital and what you're doing in the real estate space, I have to ask, you went to IU, Indiana University, and you were in their music school, which I know I have a couple friends who went through that program, one of the most prestigious music programs in the country. So how did you get from majoring in music to doing what you are today?
Yeah, no, that's a good question. And it's a little bit of a part of the story. I mean, I've always kind of, followed sort of what I'm passionate about. And I've been still passionate about music, writing music, playing music, producing music, since I was pretty young. And, in high school, that's what I was spending most of my time doing. So, why not kind of pursue that? At the same time, kind of at the end of high school, I got proposition from a friend of mine whose father was flipping houses. This was in about 2005, 2006. And he said, my dad wants to teach me how to flip a house, but you have to go out and find a partner. I can't do it all by myself. And so he kind of wrapped me into this house flip project that he was doing. And I had no idea anything about flipping houses, really how real estate market worked, but just kind of jumped in feet first. And, it wasn't really the most profitable deal by any means, but learned a lot. And all of a sudden this spark was ignited saying, okay, this real estate investing thing, there's something there. I don't know what I'm going to do with it, but it kind of that seed just kind of kept growing and growing and growing. And so when I, finished school and I started working on my own as like a freelancer, I'm not making that much money. I'm like, well, why not do some real estate on the side? And so it just kind of always a part of what I was doing. And it eventually turned into a, full-time gig that kind of really became another burning passion, kind of superseded my kind of passion for music. And that's what I spend most of my time doing right now.
So I'm sure you use your creative chops in the real estate world, but your musical career, what was your specialty? What was your genre? And what are you still doing today?
Yeah. So, I mean, I was a little bit of a master, jack of all trades, master of none. So my, what I studied, it was recording arts, production, and composition. So really on the technical side. But, I started playing guitar, started playing saxophone in high school, and played saxophone kind of throughout college, but I play a little bit of everything. I mean, drums, keyboards, kind of production, a little bit of everything.
Do you still play today?
Yeah, I still play today. A lot of guitar, still play drums, still play keyboards. At one point I was probably in 5 or 6 different bands at one point. I don't play with anybody consistently right now. A lot of my friends that I used to play with kind of all moved out of town. But I still play, every chance I get. Got guitars on the wall, grab them, play them for the kids. That's honestly most of my time playing music now is focused around, okay, I've got 2 little girls, and so we get the guitar and play some music together. So
I love that. What's really interesting to me, and I know we're going off on a musical tangent, but I love the you're watching like Sunday afternoon football, and they cut over to a feature of like a huge defensive lineman that is a beast on the field, but then he also is like a virtuoso on the piano. Is that kind of who you are? Your day job is buying and selling apartment buildings, but then you've got your passion of playing the guitar and the piano, right?
Yeah, well, it's all about being a whole person, and you can't necessarily only be doing one thing, even though you can be super passionate about one thing. And it kind of comes back. And I recently reread Grant Cardone. Think whatever you want about him. I have mixed opinions, but is be obsessed or be average. And it's not about being just obsessed with having one obsession, but being obsessed with your entire life and kind of creating that perfect life for yourself that encompasses your career, your family, your passions, and making it all work for you. So I mean, the creative aspect in music and those outlets, I think that they're absolutely critical. And it doesn't have to be music, and it can be any passion. I mean, sports, writing, art, whatever. I think it all kind of, builds up that whole person. So I wish I could spend more time playing music. I wish I had a, group to kind of jam out with like I used to, but, it's definitely still a part of who I am. And, yeah.
So let's go to day one, Gray Capital. Tell us about the early days. According to your website or LinkedIn, you guys are controlling about 8,000 units, which is not a small portfolio. So yeah. Let's go back to day one and talk to us about how your career started.
Sure. Yeah. So, I'll kind of skip past because I mentioned that kind of that first flip and that sparking of real estate, and I had flipped some homes kind of throughout my, early mid 20s, while I was trying to, figure the kind of the music career out. In that period, I started another business, kind of pursuing another passion of mine. I loved craft beer. I still do. But I was really into it, kind of seeing that growing industry back in kind of like 2012, 2013. And I was noticing all of these craft breweries having a problem sourcing all of their ingredients, and specifically kind of the hops that kind of give a lot of the flavor and make, IPAs bitter and all of that. And so we kind of stumbled into sourcing these hops for all these craft brewers, and eventually built a business as a broker, as well as we had a small hop farm as well. We ended up being one of the fastest growing, the largest distributor in the Midwest, and one of the fastest growing distributors in the United States. In about 2015, we were kind of, in a sense, kind of peaking on the business and seeing diminishing returns, seeing the market change, and we had an opportunity to kind of sell that business. And so we sold that business around 2015, and kind of looking for that next step. I had basically just been consuming myself with educating myself on, multifamily real estate, because I had the experience of flipping homes and small single family home rentals, but I just didn't think that was the avenue that I wanted to pursue. I wanted to do something bigger, something that could scale and truly build a evergreen business. And so I put a lot of time into studying multifamily operations, investing, and I eventually, my wife and I, who is the other principal at Gray Capital, we began partnering with another syndicator, a multifamily operator based in Indianapolis, and started partnering with him as a co-general partner to kind of build our own portfolio. But really, we knew what we wanted to do, but we didn't have all the systems. We didn't have like the full staff. And we just didn't have the track record and experience. And so we were able to form this great relationship where we could leverage our partners' experience, their track record, while we grew our business at the same time. And it ended up being very kind of accretive for both firms. And so we've done, over a dozen co-general partnerships with that group. Now we're also just focused on doing our own projects, our own syndications. But it's really just through the power of kind of partnering with others and kind of just creating these strong partnerships that we could kind of grow our portfolios together.
What was the biggest challenge in the opening days of that partnership or any partnership that you've been a part of? What has been that biggest challenge that you've been able to overcome?
The biggest challenge, for forming a partnership, and I guess I'll start just taking a step back, is first we weren't sure that we really wanted to form a partnership. We first started out saying we want to do our own deals, we want to control everything, and we didn't want to have to give up, a piece of the deal. And the conclusion from that mindset was, we had to do much smaller deals, start very slow, and really work our way up. But once we realized that we could grow much faster with a partner, it made a lot more sense. The biggest challenges on finding any partner, because you get excited when you first meet somebody and you think you could do something together. But, these are long-term, at least the way we look at projects, these are long-term endeavors. They could be, 3, 5, even 10 years long. And so to make sure that you are aligned, not just on your investment objectives and what you're trying to get out of it, but, what type of person is that other operator or your partner? Is it someone that you're going to want to do business with over the next decade? And so, there's a lot of speed dating that goes on in the space, especially with, larger joint venture equity, having to place a lot of money quickly, and you're trying to establish this relationship. Sometimes it's in a couple of weeks. And there's just no real good way to do that in a short period of time. So, it's taking it slow, having a lot of conversations, understanding, not just what they're doing, but why are they doing it, what their real why for investing in real estate, building their own business, and to, again, just make sure you're really on the same page.
So let's talk about your portfolio that you've amassed over the last several years. What markets are you in? What kind of product do you have in your portfolio?
Yeah. So we're focused on the Midwest. Being based in Indianapolis, the concentration of our portfolio is in the state of Indiana, but we're active kind of throughout the Midwest, with the exception a little bit of Illinois. We're a little bit not as bullish on Illinois, just not as business friendly, not as tax friendly. But the concentration in the state of Indiana. We started doing mostly kind of older properties, a value add strategy, focusing on workforce housing, and we still look for those opportunities. But in probably the past 2.5 years or so, we've made a little bit of a pivot to kind of newer properties, more in that core plus range. So when we were doing assets that were built in the late 60s through like the mid 80s, we've shifted a little bit to properties that were built in, say the late 90s, early mid 2000s. And then we actually even bought essentially a brand new property. It was built in 2019, the end of last year. And a lot of that is due to, there's been so much capital flowing into the value add space. So many of these properties have already been fixed up. And so when they're going to sell, there's not nearly as much meat on the bone as there was a couple of years ago. And at the same time, the cap rate spread between those, call it B and C class properties, older properties, and the cap rate between these, newer, A class properties, the spread is compressed considerably. And so when we're looking at an acquisition, we may be buying a C class property for in today's market, maybe a 5.5 or 6 cap, and we could go and buy essentially a new property or a relatively newer property for the same cap rate, or maybe even a cap rate above. And so depending on what the business plan is, we're getting a similar rate of return, maybe more cash on the older property, more appreciation and upside on the kind of that newer core asset. But the risk premiums on the value add just weren't enough, I guess, to justify the risk. And so once we were starting to get similar cash on cash returns, similar just overall return metrics on some of these older projects compared to newer projects, we had to ask ourselves, are we being compensated in the form of higher return on taking on these what we would classify as riskier projects, in the sense that there are a lot more moving pieces. We have to go in, renovate a property, potentially reposition the demographics of that property, move rents, achieve a target NOI to essentially to then refinance or sell. And that's still a great strategy. We still pursue those projects, but we've just shifted our strategy a little bit as the market's changed.
So how has your investor profile changed from the investors that were interested in the value add play versus now you're going after more core plus A-class properties? Do you have the same investor profile, or have you had to bring in additional capital that is looking for more of a lower risk, maybe a slightly lower return? Explain that.
Yeah, it's interesting because there definitely are quite a few investors in kind of our core investor base that is focused on kind of that value add strategy, higher cash on cash return. But I would say, the vast majority of investors that have worked with us and that continue to work with us, they're looking for more of a balanced approach, and not necessarily, I want to buy the oldest thing that's going to throw off as much cash flow. They also don't want to buy the shiniest object that's going to throw off no cash flow. And we always encourage anyone who's investing in real estate, especially if you're a passive investor, to not just focus on one deal or even one kind of demographic set or strategy, but build that portfolio of different markets, different operators, different demographics sects. So you're really well diversified for different markets. And so most of our investors, sure, they may like to have the majority of value add projects in their portfolio, but they see a place for kind of a core plus asset as well. And then the flip side, we have a lot of investors who prefer, a nicer, newer property that's going to be maybe a little bit, less on the risk spectrum. And then sprinkle a couple value add properties in to kind of increase that overall cash on cash. So I would say it hasn't really changed our investor base too much. I would say pursuing some of the newer properties has attracted a different kind of investor, a little bit more institutional. And for some high net worth and ultra high net worth individuals, they really like kind of newer and nicer assets. I hear well, I want to be comfortable, kind of walking in the building. I want to be able to, drive by and kind of, I think there's a little bit of a sense of pride that doesn't really drive us as investors, but that's something I've noticed from kind of that more institutional level or very ultra high net worth individual. They just kind of like a newer asset.
So your target markets, now that you've shifted your focus to the shinier and the newer, are your target markets in, say downtown Indianapolis or other primary, maybe secondary markets more so versus the workforce housing that may have been in less desirable markets or more suburban markets? How has that played out?
I wouldn't say that we're going to really different markets, because a part of our core investment thesis is still really secondary and tertiary markets that are off the radar from kind of the bulk of institutional capital. We want to have enough capital activity in a market to be able to sell it at the end of the day. But we're really looking for markets that are flying under the radar, which is, why we love the Midwest, because it just doesn't get mentioned in the news that often. And so, we're not necessarily going to larger markets, but we're maybe going to better locations within those markets. We never really were big urban core investors. Not that we didn't believe in the urban core prior to COVID. That's just not how it worked out. The majority of our assets are in suburban locations, and some of these very fast growing suburbs in Indiana, whether that's Hamilton County, where Carmel, Indiana is, Fishers is. It's just growing by leaps and bounds, to some other small suburbs outside of metros. Like we acquired a luxury A-class asset, 290 units, outside of South Bend, Indiana, in a small suburb called Granger, which has well over $100,000 average median income. It's has huge population growth, job growth, and we weren't as excited about South Bend, but some of these smaller suburbs, kind of on the fringes, that's where all of the folks that are in those cities are kind of moving out towards. And obviously we had COVID was a total black swan event. We weren't planning on a huge rush to the suburbs, but that is how our portfolio construction ended up looking like in the past anyway. And so we have kind of benefited from that flight to the suburbs.
So that's a great segue into the post-COVID era. I feel that the latter part of last year, from all reports that I've read, rent collections were very stable. Some operators who I've had on the show were pleasantly surprised that their collections were actually stronger than 2019 in that earlier part of COVID, say from April to September. But I've been hearing more distress out there, where rent collections have taken a little bit more of a hit. Is that news that I'm hearing and reading, is that consistent with your portfolio? Tell us a little bit how you've been able to kind of weather the storm with your portfolio.
Yeah, I think a lot of it is so market based and geographically based, because our portfolio, and again, it's not just really our portfolio. I see similar metrics when I just look at the performance of kind of Indianapolis as an MSA or other Midwestern MSAs. And this is a good example of this kind of K-shaped recovery. But I mean, last year we had our highest occupancy year to date, highest NOI growth, highest rent growth across our portfolio than we've seen really in the past 5 years, which is the exact opposite that you would really come to expect if you really read a lot of the kind of the headlines and what the media was putting out. That was really more of a reflection of what was going on in many of the primary gateway markets in the coast. So, New York City, Los Angeles, some of these large coastal cities that, many of them had, very restrictive, whether it was, eviction moratoriums or, very laws that, aren't as friendly to landlords and property rights in general. Those are the markets that have, really suffered, and people have, just continued to migrate out of a lot of those markets to, whether it's the Sun Belt or they're looking for a more affordable place to live, like in the Midwest or wherever it may be. But we're not seeing too much distress across our portfolio. Each asset has a handful of residents that have had some issue, and we've taken an approach just to work with our residents to try to make accommodation. We've honestly seen more issues in some of our A-class properties of residents who could pay, but they didn't think that they had to pay. And because we do have a little bit more flexibility in Indiana, we can still file for an eviction, whether it gets processed by the courts or not. And half the time when we do that, everyone just pays. They just had been holding out because they thought that they really didn't have to pay. So they're very kind of minute issues. I mean, it's something that we track very closely. I mean, ever since back in March of last year. I mean, we just had countless meetings and trying to model what a huge collections drop across our portfolio was going to look like, waiting for that shoe to drop, and it never really did. So it was last year was quite a roller coaster, to say the least.
So U-Haul just recently came out with their most up-to-date migration report. And number one and number two were, I think, Texas and Florida for good reason.
Yep.
I believe number three was Ohio, which I felt I wasn't necessarily surprised because Ohio is a great market, and I want to ask your opinion. Why is Ohio the number three state where people are migrating to? I'm assuming you have assets in Ohio.
We do, yeah. We have assets in Dayton and Columbus. Specifically Columbus, Ohio. I mean, it has had a great growth story over really the past decade, and it's got another one of those markets that if it was in the Sun Belt or if it was in another state, not in the Midwest, I think it would get a lot more press. Now, there's been a lot of construction there, and there certainly has been a lot of investment activity. But there are so many corporate headquarters in Columbus, a lot of new jobs that have been opening up. So there's a major driver for Columbus. Cincinnati also has a lot of very solid economic drivers. It's been growing pretty well. We have an asset in Dayton that's been performing really well. I think there are markets in Ohio that I'm not as big of a fan of. I mean, throughout the Midwest, I mean, it is still the Rust Belt, and you're seeing, some metros still shrinking, just because there's no economic drivers. But a lot of those residents, they're not all necessarily moving to, Florida or Texas or California. Some people are moving to California. Most people are moving out. But what we're seeing is that a lot of residents are moving out of these smaller towns and metros into the larger metros in those states. And so we're seeing the same thing in Indiana. A lot of the smaller towns, they're still dying, but they still want to live in the state. And so whether it's Ohio or Indiana, wherever it might be, there's that big attraction to the larger metros. And maybe it's the suburbs of those metros, but just to get closer proximity to jobs and where things are going on.
We're going to conclude this episode here in a second, but I want to ask you any other parting thoughts on anything that we haven't talked about, markets that you're targeting, or kind of deal flow that you guys are working on right now. Any parting thoughts with your business?
Yeah, I guess the only parting thoughts, maybe not necessarily specifically on markets or deal flow. I do think the market is in a very precarious position. Interest rates were so low last year. The 10-year Treasury just yesterday hit 1.3%. And so I think that we have a lot of figuring out where we are in the market. Deals that could pencil a couple of months ago because of interest rates may not be able to pencil today, and where inflation is actually going to go, because inflation will be a driver of rents, but also it's increased the cost of borrowing, and there's a huge wall of capital out there. So we're still in very much unprecedented times. I mean, unemployment rates are still very high. And so, where that is all going to go. I mean, we spent $6 trillion last year. How many trillions are we going to spend this year? We're in unprecedented times. And so I'm very happy. I mean, the best decision of my life was to get into multifamily real estate. I think we're positioned much more favorably than most industries. But I think that over the next year and a half, it's going to be a very interesting ride to see where we go economy-wise.
We're going to close out this episode, Spencer, with the hard-hitting questions. These are the questions that we ask every one of our listeners. I always start out with, what is your why, Spencer?
Yeah. My why really is financial autonomy, being able to do what I want with my family and to have full control over my time. And so, really time and financial autonomy.
Is there a recent book or another piece of media that you've consumed that's added significant value to your life or your business?
Yeah, I'm actually rereading Chris Voss's Never Split the Difference right now. I think this is like the third time I've reread it. We're reading it as a company right now. But if you haven't read that book, it's very entertaining and has so many great lessons for, negotiating, but just having to deal with people in general. And it's a very entertaining book. So if you haven't read Chris Voss's Never Split the Difference, highly recommend.
Yep, I'm a big fan. I listened to that one recently on Audible. Yep. I was definitely a big fan. Also, I'm listening for either the second or third time a great book about it's called Who Not How. So it's okay. Basically if you have a task, asking the question who can do it rather than how you can do it. 2020 was all about delegation for me. So that's also another great book. Spencer, how do you like to pay it forward?
The way I like to pay it forward is getting to talk and help other people that were in my same position 5 years ago. And I have these conversations, a couple times a week, but people who are saying, I want to get into multifamily real estate. I want to be a GP or a co-GP. How do you do it? And, I'm not a coach. I don't sell any coaching coaching services, courses, or anything like that. But I just love talking to real estate about people who are trying to get into it and trying to help them kind of carve their trajectory and kind of set the course and set them up for success, because it's been such a game changer in my life. And if I can help individuals kind of accelerate the process, and you still have to make mistakes on your own, but it's not necessarily reinventing the wheel. So that's really what I get out of it, and I love it. It's why one of the things that just keeps driving me.
Knowing what you know now, what would you tell your 20, 21, 22-year-old postgraduate self? The number one piece of advice?
Well, part of me would just say go back and get into real estate, from the get-go, and really go into it quicker and faster. At the same time, if I hadn't had all the failures in my earlier 20s, I don't know if I would be in the same place today. So I would say keep thinking about real estate, but at the same time, I'm here where I'm at today because of, the past. So can't really change it.
Spencer, how can our listeners learn a little bit more about you and Gray Capital?
Yeah, so our website's graycapitalllc.com. We put out a weekly newsletter that I think is one of the best multifamily newsletters that's being produced right now. We give you a snapshot of where all the latest interest rates, market information, all the latest research reports. And we also have a YouTube channel. So if you pop over to YouTube, Gray Capital LLC, and we'll pop up. And just get in touch with us one of those ways.
Spencer Gray, thanks so much for the time today and adding your value. We greatly appreciate it.
Hey, really appreciate it, Nick. Have a great one.
Thanks for listening. If you enjoyed this episode, please make sure to leave a rating and a review, which will help us introduce the podcast to other listeners. Also, don't forget to subscribe to our YouTube channel, which will give you access to other episodes you may have missed. Lastly, if you'd like to learn more about investing alongside us, then head on over to valueaddedpodcast.com. Have a great day, and we'll talk to you next week.